Imagine waking up tomorrow morning to discover that the dollar in your pocket, the savings in your bank account, and every financial asset denominated in US currency has suddenly lost half its value overnight. This isn't a slow erosion over years or decades, but an instantaneous collapse that catches everyone off guard, from individual families trying to pay their bills to the largest corporations and governments holding trillions in dollar-denominated assets. The immediate psychological shock would be staggering because the US dollar isn't just another currency, it's the backbone of the entire global financial system, the most trusted store of value on the planet, and the medium through which roughly 60% of international trade flows. When you understand what the dollar really represents in the architecture of modern civilization, you begin to see why a 50% devaluation overnight would trigger consequences far beyond simple mathematics, unleashing a cascade of economic, social, and geopolitical transformations that would reshape America and the world in ways most people have never seriously contemplated. The dollar's dominance means that its collapse wouldn't be contained within American borders, but would radiate outward like shockwaves from an earthquake, disrupting every economy, every government, and every individual who participates in the global marketplace. And the speed of the collapse matters enormously because overnight means no time to adjust, no gradual adaptation, no opportunity for policymakers to implement protective measures or for businesses and families to hedge their exposure. The first thing Americans would notice is what happens at the grocery store, the gas station, and anywhere else they spend money on daily necessities. Prices wouldn't just inch upward gradually, they would spike violently and immediately because a 50% devaluation means that anything imported into the United States suddenly costs twice as much in dollar terms. America imports an enormous volume of goods, from electronics manufactured in Asia to clothing produced in Bangladesh, from tropical fruits grown in Central America to petroleum products refined overseas. And all of these products would see their prices double almost instantly because foreign suppliers aren't going to accept payment in a currency that just lost half its purchasing power without demanding more of those devalued dollars to compensate. The grocery store becomes ground zero for this shock because food supply chains are global and complex, with everything from coffee beans to bananas to seafood crossing international borders before reaching American shelves, and even products grown domestically often depend on imported inputs like fertilizers, pesticides, machinery parts, and fuel, all of which now cost dramatically more. The immediate result is what economists call demand-pull inflation on steroids, where too many dollars chase too few goods. And because people need to eat, regardless of price, they'll pay whatever it costs, creating a vicious cycle where rising prices feed expectations of further increases, prompting hoarding behavior that creates artificial shortages and drives prices even higher. Gasoline prices would be among the most visible and painful increases because even though America produces significant amounts of oil domestically, petroleum markets are global and priced in dollars. And when the dollar collapses, oil-producing nations demand more dollars per barrel to maintain their real purchasing power. This creates immediate pain at the pump, where Americans who are paying perhaps $4 per gallon might suddenly face $8 or more. And because modern American life is built around automobile transportation, this price shock ripples through every aspect of daily existence, from commuting to work, to transporting children to school, to the logistics networks that move goods across the country. Trucking costs double, which means everything transported by truck becomes more expensive, from furniture to building materials to the restocking of retail shelves. And suddenly businesses face an impossible choice between absorbing these costs and destroying their profit margins, or passing them along to consumers who are already struggling with doubled import prices and fuel costs. The supply chain disruptions would be immediate and severe because modern manufacturing operates on just-in-time principles, where components arrive exactly when needed rather than being stockpiled in expensive warehouses. And this efficiency depends entirely on predictable costs and reliable logistics. When transportation costs double overnight and currency values become wildly unstable, these carefully calibrated systems break down, leading to production stoppages, product shortages, and further price increases as scarcity drives up costs even for domestically produced goods. The housing market would experience a bizarre and painful dislocation, where existing homeowners with fixed-rate mortgages would find themselves in a peculiar situation. On one hand, their mortgage debt is denominated in the now devalued dollars, meaning in real terms their debt burden has been cut in half, which sounds beneficial until you realize that their income hasn't doubled to match the price increases elsewhere in the economy, and if they need to move or buy a different home, property prices would be soaring as real estate becomes one of the few tangible assets that might preserve value during currency collapse. Meanwhile, anyone trying to get a new mortgage would face catastrophically high interest rates because lenders demand compensation for the risk that they'll be repaid in currency worth even less than today's already devalued dollars. And this would effectively freeze the housing market as buyers can't afford to borrow and sellers can't find qualified purchasers. Renters would face a different nightmare as landlords, seeing their own costs for property taxes, maintenance, insurance, and utilities all skyrocketing, would push through massive rent increases. And because housing is a necessity, people have no choice but to pay, even if it means allocating 60 or 70% of their income to rent alone, leaving almost nothing for food, transportation, healthcare, or any other needs. Noella Renza Nakpa, Plafasu. The employment picture becomes complicated and painful because different sectors would react in radically different ways to the dollar collapse. Export-oriented industries would theoretically benefit because American-made goods suddenly become much cheaper for foreign buyers, potentially boosting demand for products manufactured in the United States and creating some new jobs in these sectors. A car produced in Detroit that cost foreign buyers $50,000 would now cost them only $25,000 in their own currency terms, making American manufacturing much more competitive internationally, and companies like Boeing, Caterpillar, and other heavy manufacturers might see order books expand as their products become bargains on the global market. However, this theoretical benefit runs headlong into practical constraints because these companies depend heavily on imported components and materials that now cost twice as much, potentially wiping out the competitive advantage gained from the weaker currency. More importantly, the collapse in domestic consumer spending as Americans struggle with doubled import prices, and general inflation would create massive job losses in retail, services, hospitality, and every sector dependent on domestic consumption, which represents roughly 70% of the American economy. Unemployment would spike rapidly as restaurants close because people can't afford to eat out. Retailers shutter because consumers stop buying anything beyond absolute necessities. And service businesses from hair salons to car washes to entertainment venues see their customer base evaporate. The banking system would face an existential crisis that makes the 2008 financial crash look manageable by comparison. Banks hold assets and liabilities denominated in dollars, and when those dollars lose half their value overnight, the entire edifice of accounting, capital requirements, and risk management collapses into meaningless numbers. Depositors would panic, rushing to withdraw their savings before they lose even more value, creating classic bank runs that could overwhelm even the Federal Deposit Insurance Corporation's ability to guarantee deposits. Banks would face another nightmare in their loan portfolios because while the nominal value of mortgages and other loans stays the same, borrowers struggling with doubled costs of living would start defaulting at unprecedented rates, leaving banks holding worthless paper. The commercial real estate sector would implode as businesses fail and stop paying rent, leaving property owners unable to service their mortgages, creating a cascade of defaults that threatens to bring down major financial institutions. The Federal Reserve would face impossible choices, needing to raise interest rates dramatically to defend what remains of the dollar's value and restore some confidence, but knowing that higher rates would crush economic activity even further and make it impossible for the government to service its own debt. The federal government's fiscal position would deteriorate from serious to catastrophic because the United States carries more than $34 trillion in debt, much of it held by foreign governments, central banks, and international investors. When the dollar loses half its value, the real burden of this debt is cut in half, which sounds beneficial until you realize that foreign creditors would immediately stop buying new Treasury securities and likely try to dump their existing holdings, making it impossible for the government to finance its ongoing operations. The government needs to borrow roughly $2 trillion annually to cover the gap between spending and tax revenue. And when creditors refuse to lend or demand exorbitant interest rates to compensate for currency risk, the government faces a brutal choice between massive spending cuts that would devastate social programs and military capabilities, or printing even more money to cover its obligations, which would accelerate the currency collapse into true hyperinflation. Social Security recipients would be particularly devastated because while their monthly checks might eventually be adjusted for inflation, the adjustment process lags behind reality, meaning months or even years where retirees try to survive on fixed incomes that buy half as much as before. Medicare and Medicaid would face impossible strain as healthcare costs, heavily dependent on imported pharmaceuticals and medical devices, would double while government revenues fail to keep pace. The international implications would reshape global geopolitics in fundamental ways, because the dollar's role as the world's reserve currency gives America enormous advantages that most citizens don't fully appreciate. Countries around the world hold dollars as reserves to stabilize their own currencies, to pay for international trade, and as a safe haven during times of uncertainty. And this constant demand for dollars allows the United States to borrow at much lower interest rates than would otherwise be possible, and to run persistent trade deficits without facing the currency crises that would cripple other nations. When the dollar collapses, this entire system unravels, and countries holding large dollar reserves, particularly China and Japan with their trillions in treasury securities, would see enormous losses wiped out overnight. The immediate reaction would be panic selling as everyone tries to exit dollar positions simultaneously, accelerating the collapse and destroying any remaining confidence in American financial assets. Oil-producing nations that have priced petroleum in dollars since the 1970s would likely shift to other currencies or demand payment in baskets of currencies or even commodities, fundamentally altering the mechanics of global energy markets. The euro might strengthen dramatically as investors and central banks seek alternatives, but the European Union lacks the deep and liquid financial markets that made the dollar so useful, and the eurozone's own structural problems make it an imperfect substitute. China would seize this moment as a historic opportunity to advance the international role of the yuan, pushing harder for bilateral trade agreements settled in Chinese currency, and expanding its financial infrastructure to support yuan-denominated transactions. The Belt and Road Initiative would become not just an infrastructure project, but a mechanism for building a yuan-based trading sphere that bypasses the dollar entirely, and countries throughout Asia, Africa, and Latin America, frustrated by decades of dollar dependence and American economic leverage, might welcome this alternative despite concerns about Chinese political influence. Russia, already facing Western sanctions that restrict dollar access, would accelerate its efforts to create alternative payment systems and currency arrangements with other nations similarly interested in reducing dollar exposure. The result would be a fractured global financial system without a single dominant reserve currency, making international trade more complicated, more expensive, and more vulnerable to political manipulation as countries use currency access as a weapon. American military power, which ultimately depends on economic strength and the ability to project force globally, would face severe constraints as the government struggles with fiscal crisis and reduced purchasing power. The hundreds of military bases that America maintains around the world become much more expensive to operate when everything from fuel to food to local labor costs doubles in dollar terms, and the Pentagon's ability to purchase new weapon systems, maintain existing equipment, and pay personnel would be severely compromised. Adversaries would perceive American weakness and might take aggressive actions they would have previously avoided. From China potentially moving against Taiwan, to Russia expanding operations in Eastern Europe, to regional powers challenging American interests in the Middle East. The network of alliances that America has built since World War II would strain as allies question whether the United States can still provide security guarantees when it can barely manage its own economic chaos. The social fabric of American life would fray under the stress of economic collapse and rapidly declining living standards. People who spent their entire careers building retirement savings would watch those nest eggs lose half their value overnight, destroying carefully laid plans and forcing elderly Americans to work years longer or depend on family members who are struggling themselves. Young people would face a landscape where education costs, already burdensome, become completely unaffordable as universities dependent on imported technology, international students paying in foreign currencies, and endowments invested in now worthless dollar assets all raise tuitions dramatically. The middle class would effectively disappear as the gap between those with tangible assets that hold value through currency collapse and those dependent on dollar-denominated wages and savings becomes an unbridgeable chasm. Political polarization would intensify as different groups blame different causes for the disaster, with some pointing to government spending and monetary policy, others to trade policies and globalization, others to corporate greed or foreign manipulation, and this blame game would prevent the kind of coordinated policy response that might mitigate the worst outcomes. Civil unrest would become likely as people facing impossible choices between paying rent and buying food take to the streets demanding government action. The government would face pressure to implement price controls to stop the runaway inflation, but economics teaches us that price controls create shortages as producers can't afford to supply goods at artificially low prices, leading to empty shelves and rationing systems that breed corruption and black markets. Alternatively, the government might implement capital controls to prevent money from fleeing the country, but this would further destroy confidence and make America a financial pariah that serious investors and businesses avoid. Some economists would argue for a complete monetary reset, perhaps introducing a new currency backed by gold or other commodities. But the logistics of replacing trillions of dollars in circulation while maintaining economic activity would be staggeringly complex. And without addressing the underlying fiscal imbalances that contributed to the collapse, any new currency would face immediate skepticism. The technology sector, often seen as America's crown jewel, would face severe disruption because while software and digital services can be exported easily, the hardware that enables the modern tech economy is manufactured primarily in Asia. And when import costs double, everything from smartphones to servers to networking equipment becomes prohibitively expensive. Cloud computing operations that depend on constantly refreshing hardware to maintain performance would see costs explode, forcing price increases that might drive customers to European or Asian alternatives. The venture capital ecosystem that funds innovation would largely shut down as investors, watching their dollar-denominated funds lose half their value and facing massive uncertainty about future returns, would stop funding new ventures and focus on preserving whatever value remains. Brain drain would accelerate as talented engineers, scientists, and entrepreneurs, seeing better opportunities and more stable currencies elsewhere, would emigrate to Europe, Canada or Asia, taking their skills and innovations with them and further weakening American economic prospects. The agricultural sector presents another complex picture because while America is a major food exporter and farmers might benefit from increased foreign demand for cheaper American crops, modern farming is incredibly input-intensive depending on imported fertilizers, pesticides, machinery parts, and fuel, all of which would double in cost. Small and medium-sized farms operating on thin margins would face bankruptcy as their costs explode faster than they can raise prices, leading to consolidation where only the largest corporate operations with access to capital and hedging strategies survive. Food security, something Americans have taken for granted for generations, would become a real concern as domestic production struggles and imports become unaffordable, potentially leading to government intervention in agricultural markets and distribution systems that further distort the economy. Healthcare would face a catastrophic crisis because the American medical system depends heavily on imported pharmaceuticals, medical devices, and equipment, much of it manufactured in Europe or Asia, and when these imports double in cost, hospitals and clinics would struggle to afford basic supplies. Prescription medications, many of them produced overseas or dependent on imported active ingredients, would become unaffordable for millions of Americans, leading to people skipping doses or abandoning treatment entirely, with predictable impacts on public health. Medical professionals facing rapidly eroding real incomes as their salaries fail to keep pace with inflation might leave the field or emigrate to countries with stronger currencies, creating provider shortages that worsen access problems. Insurance companies would face insolvency as claims spike while premium revenues, often fixed by annual contracts, fail to keep pace with medical cost inflation, potentially leaving millions without coverage just as they need it most. The education system would face impossible choices as school districts watch their budgets, typically set months or years in advance, become inadequate to cover basic operations when everything from textbooks to computers to building maintenance doubles in cost. Teachers whose salaries are often modest even in good times would face severe real income declines that might drive massive attrition from the profession. Universities would struggle with endowments that lose half their value, international students who can't afford to attend, and domestic students who can't pay tuition or secure loans, potentially forcing closures of all but the most elite institutions. The long-term implications for American competitiveness and innovation would be severe as educational attainment declines and fewer students pursue the advanced degrees that drive technological and scientific progress. The cultural and psychological impacts might be as significant as the economic ones, because America's national identity is deeply tied to notions of prosperity, opportunity, and being the world's leading economy. When that identity collides with a reality of declining living standards, international humiliation, and loss of global influence, the resulting cognitive dissonance could manifest in dangerous ways, from searching for scapegoats to embracing authoritarian leaders who promise simple solutions to complex problems. The American dream, already under strain in recent decades, would become laughable to a generation watching their prospects evaporate regardless of education or effort. Trust in institutions, already declining, would collapse completely as people conclude that governments, banks, corporations, and experts either caused the disaster or were helpless to prevent it. Could America eventually recover from such a catastrophe? History provides mixed lessons, with examples of countries that experienced currency collapses and eventually rebuilt, like Germany after hyperinflation in the 1920s, but also examples of nations that never fully recovered their previous status. The unique challenge for America is that the dollar's collapse wouldn't just be a national crisis, but a global one, disrupting every economy and creating a chaotic transition period where international cooperation becomes difficult precisely when it's most needed. Recovery would require fundamental reforms to fiscal policy, trade policy, and monetary policy, along with rebuilt credibility that would take decades to establish. The question is whether American political institutions, already stressed by polarization and gridlock, could muster the unity and discipline necessary to implement painful but necessary changes, or whether the crisis would deepen divisions and lead to even worse outcomes. The scenario of the dollar losing 50% of its value overnight is extreme and unlikely, precisely because so many actors have strong incentives to prevent it. From foreign governments holding dollar reserves to American businesses, dependent on stable currency, to international institutions whose legitimacy depends on global financial stability. Yet the exercise of imagining this scenario reveals important truths about how deeply the dollar's stability is woven into modern life, how vulnerable complex systems are to rapid shocks, and how the seemingly abstract world of currency values and exchange rates ultimately determines whether families can afford food, whether businesses can operate, whether governments can function, and whether the international order maintains peace or descends into chaos. Understanding these connections matters because while overnight collapse is improbable, gradual erosion of dollar dominance is already happening as countries diversify their reserves, pursue alternative payment systems, and question American fiscal sustainability. The difference between sudden collapse and managed decline is whether policymakers recognize the risks and take action to address underlying imbalances before markets force a more brutal adjustment. The dollar's strength ultimately rests not on military might or historical legacy, but on fundamental economics, including fiscal discipline, productive capacity, political stability, and the confidence of billions of people and thousands of institutions around the world that American currency will hold its value. When that confidence erodes, whether quickly or slowly, the consequences reshape everything. Which is why the scenario we've explored, however unlikely, deserves serious consideration as a warning about maintaining the foundations of prosperity that are easy to take for granted until they disappear.